We are entering the biggest period of wealth creation in human history. That's what our guest today believes. To some degree, that headline knocks the UK election result into a cocked hat. But what about the bigger global issue of a trade dispute between the two big economic superpowers, the US and China, which are in negotiations over a new trade pact? To what degree is that going to influence the cycle that we're in at the moment? We're talking now to trends and cycle specialist Akhil Patel from Ascendant Strategy. Thanks indeed for joining us, Akhil.
Thank you for having me.
I want to start off first of all with the small picture. Politically, how much of a seminal moment was that, do you think, in the big picture, what happened last week with the Conservatives and Labour losing so much ground?
I think that for me the seminal moment was the recognition by both of the major parties contesting the election that actually there is a great demand and appetite for public investment. And you typically get, in the context of each 18-year cycle, the second half, which is indeed very much characterised by a lot of infrastructure building and so on. And so I think the fact that they were essentially almost, to a certain extent, out-competing each other on that basis was a turning point in the cycle, which I think sets us up for the second, generally much more bullish half of the cycle.
Okay, very briefly before we go into the bigger picture,
Yep.
What are markets looking like here in the UK in 2020 because of what's happened politically, or does it not really hinge on much 2020?
Well, there's been a bit of a bounce in sterling because this uncertainty has been resolved. Now, I think that can sometimes have a slightly dampening effect on the FTSE, but nevertheless, I think global markets are poised to break out, if not in the case of the US markets, breaking out already. And I think we'll see that rally well into the new year, and the FTSE and the other European markets, the Japanese markets, will follow suit.
Yeah, okay. I want to get up to speed with the charts in just a minute. Let's now talk some of the bigger picture issues like the trade pact or the negotiations underway at the moment. How important is all that, or is that nicely fitting into the cycle theory?
Well, in addition to the 18-year property cycle, I also look at a longer-term cycle called the Kondratiev wave, or the long wave named after. So Kondratiev named it the long wave. Joseph Schumpeter resurrected his research. This was based in the 1920s for a Western audience and called it the Kondratiev wave. And essentially that is a 50 to 60-year wave of rising and falling commodity prices. And what you tend to find in the upside of each of those long waves is enormous economic productivity, largely driven by what's going on in commodity producing nations, but also because the global system becomes more integrated. Now, you also find during those periods that as the world becomes more prosperous, there is increasing tension between the great powers of the day for access to markets, competition around new technologies, and so on. And so the US-China trade dispute is actually fitting very neatly into that pattern. Now, I think probably in the next year or so, we'll probably see some kind of resolution of the immediate trade dispute. But make no mistake, I think the competition between the two great powers is set to be the backdrop to a lot of investment over the next decade. Yeah.
You bring in an interesting point about the technology side of things. We hear that technology does tend to speed things up sometimes. Does this mean that the cycles are beginning to get more compact? That 18-year property cycle, you're talking about the longer term cycle. Does technology mean that we're getting through the cycle far faster than we were originally?
I've read some suggestion about that. I'm not seeing evidence of it. And in fact, I mean, for all the progress that we're seeing on a technology front this cycle, and it is indeed enormous. You look at previous periods in human history, for example, in parts of the 18th century when they rolled out the railroads. I mean, suddenly it took you 3 or 4 weeks to get across the US, and suddenly it was 3 days. I mean, that, in terms of the impact on people's sense of what's possible, I think was probably even greater than perhaps the impact of technology today in a sense. And so through all of that sort of technological progress, the ups and downs, I think the cycles have been pretty regular. And I'm open to the idea that technology might make the move quicker, but I haven't seen any evidence. So for now, I'd stick to my original thesis.
Yeah, let's go back and refer back to the charts in the context first for this 18-year property cycle. Before we get to the charts, describe the 18-year property cycle, where we are within that and what drives it.
Okay, so it's an 18-year cycle typically consisting of 2 halves of expansion, which on average last about 7 years. The second half, the second 7 years, is the more bullish half. you particularly towards the end of that, you get a really great acceleration in economic activity and asset prices accelerating and so on. And then you get the major sort of banking and financial crisis and property market crash and stock market crash. And it usually typically takes about 4 years for that to play through. The current cycle started around 2011, 2012, and we are approaching the end of the first half of the cycle and should be expecting or experiencing, indeed in some parts of the world, a mid-cycle slowdown. They're typically not very long, and central banks reverse interest rate policies, governments act to stimulate the economy, and we typically get out of those recessions relatively quickly, and that stimulus sets up the second half of the cycle.
So in the context of what you just said, let's bring up a chart of the Dow Jones Industrial Average, which is called the Wall Street Index on the IG platform. And here we have it going back. In fact, this goes back to 2005. You can see the drop there down in 2009. And you're talking there about the 2011 period where that started. Since then, the Dow has risen to date at the back end of 2019, 170%. Explain how this fits into the cycle, because we said at the top we're entering the biggest period of wealth creation in human history. That itself is a massive headline. How does it translate into this sort of chart?
Well, I think this is an indication that, I mean, it's been such a bullish bull market. Sorry, it's sort of emphasising the point. I mean, the longest bull market in US history, and we've talked about why that is. I mean, it's just because of low interest rates and so on, but actually it's because company earnings have been very strong. Now, there's several factors into that, but it's a sign for me that US companies, particularly those that are exporting into the rest of the world, and those are concentrated on in the Dow, are just seeing lots and lots of opportunities. And, you know, post mid-cycle slowdown, if we, to the extent that we get that, I just see the continuation of the bull market.
Yeah, okay, from 2011 to where we are now, that's 8 years, so forth. How much, you talk about two halves of 7 years. Can we use what we've experienced since 2011 as we'll just replicate that over the next period to give us our end point of this cycle? In
terms of the peak price of the Dow?
Yeah.
Unfortunately, it's not quite as straightforward as that. It sort of largely depends, I think, on the extent of the correction at the mid-cycle. And that, I think, I mean, while it's been a very strong bull market, it's not been a bubble such as we had in the first half of the last cycle, where we had the dot-com boom, which really translated into a major bubble and markets came down very hard. And then particularly for the Dow and the S&P 500 in the last cycle, by the end of the cycle, they only got back up to the previous highs. If we have that kind of scenario again, you might expect something similar. So it would be an equivalent period, but we might end up at the same price as we are now. I'm not really expecting that. I think the correction will be relatively less than we had.
Quite shallow.
A bit shallower. It might be more of a bear market. But not going down significantly. It might go sideways.
And what are the catalysts or the trigger points for that we should watch out for?
For the correction? Yeah. Well, typically, it's, I think at this point in the cycle, it's if you have unexpected interest rate rises. And now I know that the chairman of the Federal Reserve has ruled that out, but of course, if there were some kind of shock in the Middle East, which led to a major surge in oil prices, that might then start to create inflation, which then might start the Fed on a tightening course. And that's indeed what has typically triggered the peak of each half of the real estate cycle every time. The other thing I wanted to say is that if you take data for the broad US markets back to 1800 and sort of cut them up into 18-year segments, you find typically at the end of the cycle, so this is the end of the cycle that I'm forecasting for the mid-2020s, the median fall in the Dow or the broad US market at the end of the cycle is 48%. So these are major kind of market events that investors need to be prepared for.
And how does all this then fit into the longer term, almost lifelong cycle?
So the long wave, well, we're on the upswing of the long wave. Now, if you were to Google long wave or Kondratiev wave, there's actually quite a lot of commentary about it. A lot of people are saying that we're in the Kondratiev winter, which means we're on the downside of the long wave. I think that's mistaken. I think if you look at some of Kondratiev's original analysis, and he talks in quite qualitative terms about technology progression, about kind of social tensions and maybe a revolutionary air in the second half of each upswing. I think you're seeing all of that now. They are very major sort of wealth building events, as I mentioned, and we are approaching the peak, I think, of that towards the end of the 2020s. So you're having the coincidence of both the second half, the more bullish half of the real estate cycle, and the peaking of the K-wave at the same time, and you don't get that scenario very often in history. So that's the underlying basis for my rather bold claim that this is, we're entering the biggest wealth building period in history. And I just want to add on that point. In previous long wave peaks, we've had growth in the West or growth in Africa or maybe in sort of emerging markets. I think this time we're seeing growth all over the globe, and it's not just economies emerging from a low base. I mean, China is in some sense an advanced industrial economy. The demographics in Africa and certain parts of Africa are just fantastic, and they're almost leapfrogging stages of development, and you're having all of this coming together in sort of one period in history. So I'm incredibly bullish about the next few years.
Does politics get in the way at all? We're hearing a lot about the resurgent left wing in the States, Elizabeth Warren particularly, with her ideas of curbing excessive wealth. It's almost like a Corbynistic type attitude towards wealth creation. If that sort of political ideology came to power, would that interrupt the cycle?
Well, to the extent that wealth is mobile, then yes. I mean, it could certainly move wealth around the globe, but I don't think there's appetite across the globe for that kind of policy. So potentially that might have a dampening effect on the US. By the way, I don't believe that. I think the Democrats will learn a lesson from the UK election and probably start attacking it slightly more towards the centre. And nevertheless, I think America is a country of so much opportunity that there are often, and politics is so difficult that a candidate might have a platform but not necessarily enact their policies. Yes, I mean, politics can get in the way, and we saw that post-Great Depression, which should have seen the start of the next 18-year cycle, then trade tensions were such that we all started fighting with each other for several years, and that of course then interrupted the cycle because there was no wealth building going on at all. We were just sort of a war economy. So yes, politics can get in the way. I'm not sure that we're at the point yet or at all where that will be the case. I think people start to see and people get much more focused on making money when the opportunities are so present.
Yeah. As a strategist, I just want to finally put everything together and bring you back in to take a look at perhaps maybe something that's a little bit outside your remit because of shorter term. How do you feel about 2020 as an investor and a trader of the markets?
Well, so I'd been sort of forecasting 2020 to be a bit of a down year, partly because it sort of coincides with the middle point of the real estate cycle. But if you look objectively at the charts of the US and the UK and Japan and France and so on, it just looks like markets are breaking up. So I think at least for the first few months, maybe even the first half of the year, we're looking at rising, markets surging up into. And of course, we have the US election, and it's in Trump's interest to ensure that everything is looking very rosy. And in fact, he tweets about the stock market going into all-time highs. So I don't see a very significant market correction, at least until the middle of next year, and probably even beyond that, unless there's some kind of shock. So I mentioned the potential for, say, something in the Middle East to cause a surge in oil prices, which can sometimes feed into the US economy in terms of inflation. But also, potentially if it looks like a very left-wing Democratic candidate is going to win the primary, that can sometimes create a bit of a market shock. So that's also something to look out for.
Akhil, thanks indeed for joining us, and a very good and prosperous 2020. That's Akhil Patel from Ascendant Strategy.